Real-world asset tokenization starts with a simple distinction. The token is usually a digital representation, not the asset itself. Its value depends on enforceable claims, compliant operations, and clear control over the underlying off-chain asset. So far, we've moved from the regulatory problem to proposed US market structure and stablecoin laws, to the business choices behind stablecoin products. Now we turn to tokenized real-world assets, what counts as an RWA, how regulation may treat it, and why stablecoins often become the settlement layer. Real-world asset tokenization uses a blockchain token to connect investors or users with something that exists off-chain, such as real estate, commodities, funds, or financial instruments. But the token is not automatically the asset itself. It may represent ownership, a beneficial interest, a legal claim, or a record used for settlement and reporting. The key question is, what right does the token holder actually have? RWA tokenization is not one market. It is a landscape of asset types with different liquidity, legal structures, and risk profiles. Cash-like and fixed-income products include treasuries, money market funds, and bonds. Private market assets include private credit, fund interests, venture capital, private equity, and real estate vehicles. Commercial claims include invoices, receivables, trade finance, and revenue-sharing contracts. Tokenization can also represent physical or environmental assets such as commodities, property, carbon credits, and renewable energy certificates. Tokenized treasuries and tokenized money market funds are popular because the underlying assets are familiar and regulated, while ownership records can move on blockchain rails. An investor may hold a token connected to a fund vehicle, a note, or a custodial arrangement backed by treasury bills, cash, or money market instruments. The appeal is faster transferability, clearer reporting, collateral use, and yield-bearing cash management. The legal analysis starts by identifying exactly what the token represents: fund shares, an issuer claim, or beneficial ownership recorded digitally. Debt and credit are especially important RWAs because they turn tokenization into a claim on future cash flows. A tokenized bond may represent a company, government, or structured issuer promising repayment. Private credit may represent loans or pools of loans. Invoices and receivables are payment rights from real commercial activity, often tied to trade finance or working capital. Here, the token is only as strong as the credit process behind it. Underwriting before funding, servicing during the life of the asset, default controls if payments fail, and legal enforcement when claims must be collected. Physical assets change the tokenization problem. With a bond or fund share, the off-chain record is usually standardized. With property, gold, cars, or inventory, the token depends on real-world controls. Who holds the asset? Who verifies title? How is value measured? What happens if it is damaged, stolen, or redeemed? Real estate tokens may represent equity, debt, or economic exposure, not direct ownership of the building. Commodity tokens often rely on warehouse receipts and insurance. The mental model is simple. The token is only as trustworthy as the custody, legal, and audit systems behind it. Carbon credits begin with a real-world claim, an emissions reduction or carbon removal recorded in a trusted registry. A token can make that claim easier to transfer, trace, and retire. But it does not create the credibility. Quality still depends on the underlying project, methodology, vintage, verification, and audit trail. The biggest risks are double counting and unclear retirement status, where the same benefit is claimed twice. For environmental assets, coordination with registries, standards bodies, auditors, and disclosure frameworks is what turns a token into something markets can trust. Tokenized fund interests are not the same as freely transferable crypto assets. The token may represent an LP interest, fund share, feeder interest, or beneficial interest held through an intermediary that can improve operations through cleaner cap tables, faster investor reporting, controlled secondary transfers, and automated checks before settlement. But private market rules still travel with the asset. Transfers may depend on accreditation, jurisdiction, lockups, redemption windows, and fund consent. The design point is alignment. Blockchain rules must match the fund documents, subscription agreements, administrator processes, and securities law. A blockchain token can show a balance, a transfer, or a record of ownership. What matters is the legal claim behind it. Does the holder own an asset, a share, or only a promise of economic exposure? Can they redeem it, and on what terms? Can they transfer it freely, or only with approval? If someone fails to perform, what remedy exists? The token is the interface. The enforceable rights are what define value. Not every RWA token gives the holder the same thing. In the strongest version, the ledger entry is intended to be the ownership record itself, if the law recognizes it. More often, the token represents a beneficial interest through a custodian, trust, fund, or SPV. Another model is an issuer claim, such as a note backed by assets. Sometimes the token is only a settlement or record-keeping tool, while legal title remains off-chain. The practical issue is not just what the token says, but who must perform for the holder's rights to be real. Tokenization is best understood as an operating lifecycle, not a one-time mint. It starts with origination, confirming the asset exists, ownership is clear, and the risk profile is acceptable. Structuring then converts that asset into enforceable rights through legal documents, governance, and service providers. Issuance brings investors in, while transfer controls enforce KYC, AML, eligibility, and jurisdictional limits. After that, servicing becomes the real work. Income distribution, record updates, reporting, audits, and exception handling. Finally, redemption or settlement closes the loop, returning value and preserving a complete compliance trail. Tokenization does not eliminate the traditional market stack. It connects to it. Smart contracts can record ownership and automate transfers, but real assets still need custody, trusteeship, administration, distribution, and compliant settlement. Custodians and trustees protect the underlying asset and investor rights. Transfer agents and fund administrators maintain the official books, handle subscriptions and redemptions, and support reporting. Broker-dealers and other intermediaries manage access, eligibility, and trading compliance. Oracles and payment rails bridge data, prices, status changes, and cash movement back to the blockchain. Definitions are not legal housekeeping. They determine the operating model. If an RWA token is treated as a security, fund interest, loan participation, payment instrument, or contractual claim, the obligations change immediately. Classification affects who can invest, what disclosures are required, how custody works, whether transfers are restricted, and how redemption or liquidity can be offered. It also drives tax, accounting, service provider selection, and compliance cost. The practical takeaway is simple. Define the asset, rights, obligations, and transfer rules before designing the product, not after launch. Real-world asset tokenization is a bridge between assets, rights, and institutions. The token matters, but the enforceable claim behind it matters more. Successful RWA products connect asset categories to legal rights, custody, administration, banking, and regulated market access. From here, the natural next step is regulation. Then stablecoins as settlement infrastructure for tokenized markets.